Thank you, Mr Speaker. As earlier speakers on behalf of the Labor Party have said, the Labor Party supports this bill, and as far as it goes, it does improve the prudential supervision of insurance companies to help protect New Zealand consumers by ensuring that those insurance companies act prudently, maintain prudent balance sheets and don't fail. That's important because insurance companies are repositories of not just contracts of insurance that people expect them to be able to honour if they if they die, for example, and have life assurance, but also because insurance companies are also repositories of money through endowment policies and the like that we need to ensure are robust. Now, that's good as far as it goes, and I think it's probably been brought forward because of the effects of the global financial crisis and the failures that we've seen around the world of some very large insurance companies and the many billions of dollars of cost that has caused, not just to consumers through insurers not being able to honour their contracts of insurance, but also because taxpayers have had to bail out those insurance companies. There have actually been some multi-billion-dollar investments in respect of some of the insurance companies in the United States. In terms of the wider issue, or in terms of how this is done, it's done by increasing the powers of supervision of the Reserve Bank, and they're the body that's been given these increased supervisory powers to maintain prudential supervision of insurance companies. And the point that has probably been made by some of the prior speakers in respect of this is that there is a lost opportunity here to actually go further in respect of prudential supervision of our banking sector and how this could assist our export sector through influence on monetary policy. At the moment, the New Zealand Reserve Bank has a almost singular focus when it comes to monetary policy on interest rates. They try to take the excesses out of the economy by putting interest rates up and therefore suppressing consumption to prevent asset bubbles or to ameliorate the effect of asset bubbles and to take the heat out of the economy, which is inflationary. Their reliance on that single instrument has had a detrimental effect on the export economy. The export economy has, in New Zealand, suffered a number of detriments. For a start, the way in which we have implemented monetary policy in New Zealand means that we have structurally higher interest rates than our competitors. So whether you're a farmer or you're another exporter in the manufactured goods area, you're facing higher interest rates in New Zealand than are faced by our competitors overseas. That has a number of detriments. The first is that the exporter or the investor in a New Zealand enterprise has a higher cost structure than their competitors overseas in respect of interest rates. So if this was a manufacturer producing widgets and all the other things were equal, the widget manufacturer in New Zealand has a higher cost structure than their overseas competitor because we've got structurally higher interest rates. And after this 20 years of current monetary policy in its current incarnation, you do actually have to question, in my view, whether the higher interest rates that we have structurally in the economy now are actually partly an outcome of current monetary and Reserve Bank policy. And this legislation, which changes the prudential requirements for insurance companies, could have actually taken a similar approach in respect of banks so as to introduce more tools to the Reserve Bank so that they don't have to rely exclusively on the interest rate tool. The second detriment that's suffered by New Zealand businesses as a consequence of those higher interest rates, which undermines their ability to invest in productive plant that we need to improve the overall productivity of the New Zealand economy. The second detriment is that you actually are effectively creating an unlevel playing field in a world where you've got global flows of capital. And if you have a bidder for a New Zealand business that's profitable, who is sourcing their funds for that business from an overseas source of funds, they pay a lower interest rate in their home country than a New Zealand borrower can borrow in New Zealand, unless they're a multinational like Fonterra and they borrow from the international market. But for a small to medium-sized business facing competition for the purchase of those same assets from an overseas purchaser, again, if everything else is equal, if they're facing the same wage costs, the same sale price for their goods, the same cost of their raw materials, if everything else is equal, the overseas buyer can afford to pay more from that same productive New Zealand asset compared with the New Zealand purchaser of those assets, because the overseas purchaser has a lower cost of funds. So all other things being equal, they can afford to pay a higher capital sum for that same business enterprise. And I just don't think that that's in the long-term interests of New Zealand. So we actually need to have some mechanism, different mechanism for the Reserve Bank to take the pressure off the interest rate device. We also know that the sole reliance on the interest rate device, according to the exporters, is causing volatility in our exchange rate, which is difficult for them. The volatility of the New Zealand exchange rate is extreme. The New Zealand currency is the fourth most traded currency in the world. It's an astounding statistic. We have our currency is traded more than the Indian rupee, a vastly bigger currency than New Zealand. It's traded more than the Brazilian real. It's traded more than the South African rand. These are economies that are vastly bigger than New Zealand's economy, and yet there is more trade in the New Zealand economy and the New Zealand dollar than there is in any of those currencies. I think we're even more traded than the Russian the Russian ruble. Well, perhaps it's because we have higher structurally higher interest rates, and people are speculating on their knowledge that the New Zealand Reserve Bank pulls that trigger harder than most other countries in the world have historically. So the exporters say we actually need some more tools in the toolkits other than the interest rate, and they actually say that we need to be using prudential tools in respect of banks more than we do. And that's why this is relevant to this discussion, because here we have the Reserve Bank being given more tools in respect of prudential supervision of the insurance sector, and yet in the banking sector we've got very limited ways in which those prudential tools can be used by the Reserve Bank. Now, the Reserve Bank's got two main functions. The first is maintenance of stable prices, and the second is maintenance of stability in the financial sector. And there isn't much doubt that although relative to the rest of the world we did pretty well during the global financial crisis, we still weren't perfect. We had to have government guarantees of banks, both in terms of their retail deposits and their wholesale deposits, and we had to have the Reserve Bank also buying packets of securities from financial institutions. So whilst we might have done better relative to some other countries, partly because of the savings history of Australia and the strength of their banks, not because of our own New Zealand-based savings, I would note, it's true that we're not perfect, and I think it is worth considering increasing the powers of the Reserve Bank in respect of not just insurance companies but also banks, so that they can use prudential ratios to stop the rapid growth of credit in times of in boom times. Because in New Zealand, what we do is we ratchet up the interest rate. The interest rates that New Zealand borrowers, including exporters, have to pay goes up. Their cost structure goes up. Actually, most of that money ends up going overseas because it's owed to overseas lenders. It doesn't stay in the New Zealand economy. And the Labour Party believes that we should actually be conferring and making it explicit that the Reserve Bank, instead of relying purely on interest rates, can actually adjust prudential ratios for the bank so that they actually have to source more of their money offshore. Sometimes they'll have difficulty doing that, and we actually will stop some of these flows of hot money in and out of the country, which is really what caused the overinflation of the property market. The overinflation of the New Zealand property market was not based on New Zealanders saving more money and therefore having more money in the bank to spend on assets. It was actually because the liquidity in the New Zealand economy increased because of the banks borrowing a lot of money offshore and lending it in New Zealand. And that was good for the banks. They earned a little extra margin, but it wasn't good for the New Zealand economy because it inflated the property bubble, and it did add to the imbalance in the New Zealand economy. So this bill is good as far as it goes, but the government is missing an opportunity to make it explicit that the Reserve Bank can use prudential ratios for monetary policy purposes. They can only do that tangentially at the moment. They can only use prudential policy, first and foremost, for the prudential supervision of the bank. We say they need to be doing more than that and use prudential ratios to control the growth of credit. Thank you, Mr. Speaker.
Okay. I call Craig